Elon Musk doesn't just want to build a million-person colony on Mars. He also has ambitions for Tesla to build 20, maybe 10 million EVs per year by the 2030s. However, that figure does sound a lot like Elon speak. The Tesla CEO often makes outlandish statements. Even Wall Street analysts, who are the most gullible financial analysts out there, paused for breath on the 20 million Teslas per year target. Perhaps Musk isn't as crazy as his ambitious growth plans look. We can take a look at some very simple statistics in this video, so keep watching to find out. Tesla was founded in 2003, and last year the company made 1 million Teslas. That's 18 years to reach the 1 million annual production rate. So if it's taken 18 years for Tesla to reach the 1 million annual production rate, how is it going to achieve 20, maybe 10 million EVs by the 2030s? Tesla currently has two production sites, California and Shanghai. The California site produces 600,000 cars per year. Shanghai produces 450,000 cars per year. California and Shanghai will soon expand production facilities. Meanwhile, Tesla has just opened a new gigafactory in Berlin, Germany, and another one is in development for Texas. Berlin and Texas are expected to have a combined annual production capacity of 900,000 EVs per year by 2025. Obviously, to reach that 10 to 20 million EVs per year goal, Tesla will have to construct more gigafactories. Indeed, Tesla is already looking to build a second factory in China. It takes about 12 months to build a Tesla gigafactory and a further 12 to 24 months to reach full production capacity, so 2, maybe 3 years in total, excluding delays. Even with those simple numbers, it appears the 10 to 20 million target is way overambitious. As a guess, a 5 million annual production rate by the 2030s seems more realistic. However, according to Elon Musk on Twitter, Tesla has a master plan up its sleeves. Tesla will be scaling to extreme size, Musk said on Twitter. Speaking at the launch of the Tesla Berlin Gigafactory, Musk said, "I think it's aggressive but not impossible that we could do 20 million cars in 10 years. And that would be a good number because there's 2 billion cars and trucks in the world that are in active use. So 20 million would be the 1% of the global fleet per year." Tesla shares also spiked on March 28th after news that the Austin-based electric vehicle maker is planning its second stock split since 2020. The company on March 28th announced plans to seek stockholder approval at its 2022 annual meeting for the plan, which would increase the number of common shares to enable a stock split of the company's common stock in the form of a stock dividend, according to the announcement. Tesla Incorporated shares were up 8% by the end of March 28th, closing at $1,091.84, and giving the company a market cap of roughly $1.13 trillion. Track the stock in real time here. The proposal has already been approved by Tesla's board of directors. More details are set to be revealed through an upcoming proxy statement for the annual meeting, which is likely to take place in the fall. The company's 2021 annual meeting of stockholders was held October 7th. The stock split announcement is switched between two major milestones for Tesla: the March 22nd grand opening of its factory in Berlin and the upcoming April 7th grand opening of its East Austin Gigafactory, which is expected to hire thousands in Austin. Elon Musk's companies have increasingly eyed Austin for expansion, while entities tied to the billionaire CEO continue to scoop up land and plan for construction projects in the area. Investment firm Wedbush Securities Incorporated, in a March 28th report, maintained its $1,400 per share price target for Tesla stock, calling the split announcement a smart strategic move that will be a catalyst for shares going forward. Tesla executed a 5-to-1 stock split in August 2020, Wedbush noted, suggesting the timing is right for another split, considering the high demand for electric vehicles and the two new factories coming online. Tesla will seek investor approval to increase its number of shares to enable a stock split in the form of a dividend, the electric car maker said on Monday, sending its shares up about 5%. The plan came as the company suspended its Shanghai factory amid COVID-19 related lockdown measures, and its artificial intelligence head took a sabbatical as the company aims to achieve full self-driving capability this year. The proposal, first announced on Twitter, has been approved by its board and shareholders, and will vote on it at an annual meeting. The stock split, if approved, would be the latest after a 5-for-1 split in August 2020 that made Tesla shares cheaper for its employees and investors. Following a pandemic-induced rally in the technology shares, Alphabet, Amazon.com, and Apple too have in the recent past split their shares to make them more affordable. Tesla debuted at $17 per share in 2010. Following its 2020 5-for-1 stock split, it is trading above $1,000, equivalent of over $5,000 in a pre-stock split basis. Since the stock split in 2020, they have surged 128%, boosting the company's market capitalization above $1 trillion and making it the biggest U.S. automaker by that measure. Wedbush analyst Dan Ives said multiple stock splits in such a short span only happen when, quote, a company is delivering massive growth. It's a retail-driven move, and we view it as another positive catalyst that puts more fuel in the rally, Ives said. Tesla shares began the year trading at nearly $1,200 per share, but the stock traded at $766.37 as recently as March 14th. The March 28th rally brought shares about $100 shy of where they started in 2022. Also in March 28th, Musk announced on Twitter that he appeared to have tested positive for COVID-19, though he reported having minimal symptoms. U.S. stock markets opened mixed on the last Monday in March, with news of a stock split by Tesla supporting a market that was otherwise burdened by rising bond yields and signs of an inflation-driven slowdown in consumer spending. The Dow Jones Industrial Average was down 156 points. The broader S&P 500, however, was down at least 0.1%, and the NASDAQ Composite was up 0.7%. The most eye-catching early move was by Tesla stock, which gained 6% to its highest in over 2 months after the electric vehicle maker said it intends to split its stock, a move that typically makes it more attractive to small investors. To what extent that it still holds in an age where electronic brokerages routinely offer fractional stocks isn't entirely clear. The news was in any case offset by the fact that Tesla's factory in Shanghai is set to remain shut this week due to rolling lockdowns imposed across the city of 25 million people. The factory currently produces just under 10,000 vehicles per week. Over the last 2 weeks, stocks have made up more than all of the losses they suffered in the wake of Russia's invasion of Ukraine, and then some. That's despite a sharp rise in bond yields that threatens to raise capital costs for the economy at large. A string of Federal Reserve officials last week hinted that they would have to accelerate their plans for raising interest rates in order to get inflation back under control. Bond markets remained under pressure in New York, with short-dated yields continuing to rise, although longer maturity yields eased on the back of growing confidence that the Fed won't fall any further behind on the curve of inflation. Inflation was behind one of the other main pieces of news from the weekend. Japanese newspaper Nikkei reported that Apple intends to cut production of its iPhone SE, AirPods, and other hardware in response to weakening demand for products whose prices have always carried a substantial premium. Apple was reported to be looking at introducing subscription plans for hardware, another move that suggested that customers are starting to balk at high prices. Elsewhere, Poly stock rose 50% after HP agreed to buy the maker of work-from-home apps in a deal worth $3.1 billion, including debt. Oil and gas stocks retreated as crude prices came off their recent highs in response to the news of Shanghai's lockdowns, which will ban private cars from the streets while they last. The lockdowns, while not as severe as those seen in China at the start of the pandemic, show us what is now a countrywide struggle with the less dangerous but more transmittable strains of COVID-19 that have developed since the first wave of the virus in Wuhan 2 years ago. As a result of this, ExxonMobil stock fell 3.4%, while Occidental Petroleum stock and Devon Energy stock both fell 4.1%. This leaves a gap for Tesla stock to explore in the coming weeks. So what do you think will happen to Tesla stock? Comment down below.